Hello, ladies and gentlemen. This is Sanford Khan. I'm an economic consultant and business author. The title of this presentation is How to Protect Yourself, How to Protect Your Butt Before the Stock Market Bubble Bursts. And it will burst. I made a video some time ago titled The First Law and Only Law of Financial Bubbles You Need to Know. And this law is all bubbles burst, including the stock market bubble. Don't let people tell you we're not in a bubble. We most certainly are. This bubble could get bigger. I don't know when it will burst. No one knows. But it will burst. Something will burst it. It could be higher taxes coming in 2021. It could be an election that's indecisive. No one knows the winner for maybe a week, 2 weeks, 3 weeks after the election. It could be another serious outbreak of COVID-19. Or it could be the federal government just runs out of stimulus and doesn't know what to do. I mean, politicians don't know what to do. I don't know, but it will burst. So what I'm going to do is give you some examples of things you could do with your stocks. You may not own the stocks that I'm going to be talking about, but you could copy, you could instigate what I'm talking about, you could apply to stocks you own. These are major companies that have options on it, calls and puts. If you're going to do this strategy, and only you could decide if this strategy is suitable for you. The key word is suitable. Only you could decide that, not me, not anybody else, no one else. Only you could decide if this is suitable. So I'm giving you some ideas. The prices I'm going to use on these stocks, I'm going to give 2 or 3 examples of well-known stocks, depending on how much time. I don't want this video to go on more than 15 minutes. And they're going to be based on the closing prices of September 14th, 2020. End of close of trading of September 14th. I'm rounding prices off to the nearest dollar. Forget about the cents, just to make it easier. You know what's interesting, I was reading in the Wall Street Journal today, the mother of all financial bubbles, the mother of all financial bubbles burst exactly 300 years ago this month, September 1620. That was the South Sea Trading Company financial bubble. It burst. It was a huge bubble at that time. A lot of people got wiped out, including Sir Isaac Newton. Remember Sir Isaac Newton? Force is equal to times mass times acceleration. That's one of the things I learned in physics. This will be no exception. It's interesting that was exactly 300 years ago. It's also interesting that I read that Warren Buffett is getting out of some of his more speculative stocks and getting into more conservative stocks now. So it's something to be concerned about, and I think maybe you should start protecting yourself. I'm protecting yourself with puts. That means buying puts. Buying puts means you have the right to put the stock to a person at a certain price within a certain time limit. I'm going to be using from today, let's say November 14th, I'm going to be using September 14th, I'm going to be using the November, let me look at my notes here, the November 20th calls and puts, okay? You could go into your option page in your brokerage and use any one you want. I'm just using this as an example only. That's it. So let me show you how you can protect yourself on some of the more speculative stocks. It even works for those who aren't stocks that aren't that speculative but gone up. I'm doing the stocks that have gone up a lot. And these are probably high-tech stocks. Well, they are high-tech stocks. But even others, you could use the same strategy to protect your butt. Okay, let's go. My glasses, because I got to look at my notes. And I don't want to be squinting while I'm talking to you. So let's look at Facebook. It closed today, September 14th at $266 a share. The low, 52-week low, is 137. So it's had a pretty good run, like 200%. It's going up, doubled. So let's say you own Facebook. I don't know how many shares, but let's say you want to protect some of your shares. You own, let's say, 500-600 shares. And you want to protect maybe 300-400 of them against a 10% downside, fall downside. So it's 266 at close on September 14th trading. So what you could do is you could buy the 240 put. That's about 10% decline. You could buy these, depending how many you want to buy. A put is for 100 shares. Now it protects you. One put equals 100 shares. So if you have 500 shares, you could buy 5 puts. You could buy as many puts as you want, but I'm just saying if you want to protect the shares you have. You could buy 240 put, November 20th, 240 put for about $1,000. That'll give you protection down to 240. But you say, wait, my God, that $1,000 is a lot of money. I don't want to spend that. Well, there's a way you could help finance that. You could sell a November 20, 295 call, $295 call. That gives somebody the right to call it away. Remember the put, you're putting it to them. You're putting it to them at 240. If it should fall down, you could put it to them at 240. It gives you protection down to 240. You're paying $1,000 for each put for 100 shares, but you can put it to them. When you say, well, that's a lot of money. Yeah, you're right. But what you could also do, a hedging strategy, is that you could sell a November 20, 295 call. So the stock gets above 295 call by November 20th and stays there, somebody will call it away. But don't forget, it closed at 266. That's another $30. For that right, for somebody to call it away, they're going to pay you into your account, cash, $940 for every call. So that offsets the great majority of the $1,000 except for about $60. That's a strategy you could use on Facebook. You know, this market is extremely in the stratosphere, extremely in the stratosphere. And let's say it is called away at 295, okay? Well, you could, fine. You lose how many shares? If you have 2 or 3 puts, you lose 300 shares. Fine, you made your money. The Warren Buffett of his time back in the early 1900s was Bernard Baruch. He said, you're never going to go broke taking a profit. Never. So take your profit, and then you could put it into something else. So let's look at something else. What about Microsoft? The symbol for Microsoft is MSFT. Symbol for Facebook is FB. Microsoft closed on September 14th at $205 a share. The 52-week low is $133. So you can say, I want to protect myself against a 10% decline. You can make up any percent. You could say 5%, 10%, 15%, 20%. Just make it up. I'm just using 10%. 10% is a nice, even number. So is 20%. But anyway, so you say, I want to protect myself for a 10% decline in Microsoft. So that would be about $185, right? So you could buy a November 20, 185 put. That gives you the right to put it to somebody at $185 a share. 10% decline. For that right, you'll pay $540 for that put, for one put. Well, you say, well, okay, $540. How can I offset that? I have the answer. You could sell a November 20 call at a strike price of $230. That gives somebody the right to call it away from you at $230. Don't forget, it closed today at $205. So you're talking about another $25 increase in the price of the stock. And for that right, they will pay you cash in your account of $460. I want to make something clear here. If you're going to do the strategy, calls and puts, you have to have a margin account, and you have to use a broker that doesn't charge commissions. Because once they get into commissions, it really takes away from your rate of return, and there's plenty of them that do not charge. The one I use charges no commission. The only thing they charge is 65 cents for every put or call. For each call or put, they charge 65 cents. That's no big deal. So for 2 calls or 2 puts, that's $1.30. That's nothing. So use a zero commission broker. And don't take their advice. Use your own advice and see if this is suitable for you. Anyways, you buy a November 20, 185 put on Microsoft for $540, and you sell a November 20, 230 call. Again, somebody has the right to call it away from you at $230 for $460. So that offsets a great majority of the price of the put. Again, if it's called away, because it goes to 230 and above by November 20th, take your profit, put it somewhere else. Play the game somewhere else. Take your money and play somewhere else. You don't have to do this on all your shares. You could just do it on some of your shares. You could just get used to doing it. You could just take 100 shares or 200 shares and just try it out and see how it works for you and see if it's suitable. You could always unwind the position if it's not suitable for you. Let's do one more and we'll call it quits. Here's one that's very, especially with this lockdown, not lockdown, partial lockdown, people staying at home. They're entertaining themselves. Netflix, symbol is NFLX. It closed today, September 14th, at $476 a share. The 52-week low was $252 a share. So you say, I want to protect myself against a 10% decline in Netflix. And this is a highly volatile stock. And a 10% decline could happen within a few days or even one day. So what you do, 10% decline would put you down to about $440. So you buy a November 20th, 440 put, strike price 440 put for $2,700 for each put. That's a lot of money. I agree. A lot of money, folks. A lot of money. That gives you protection down to $440, but you're buying it for $2,700. Well, you say to yourself, how could I offset that? So you could sell November 20th, 520 call option. That gives somebody the right to call it away from you at $520 a share. It's got to go to 520 and above before they do it. But they have that right, not the obligation. They have that right to do it. So that November 520 call, November 20th, 520 call is going for $2,700. Guess what? This protection costs you nothing. Your risk is that Netflix goes way up to $300, $400, $500 a share, and somebody calls it away from you at 520. There's always trade-offs here, folks. There's always trade-offs. That's what you're doing. It's trade-offs. You're protecting yourself. The whole idea of this presentation is how to protect your butt, against a decline in the stock market because we're in a bubble. I'm saying this bubble could get bigger. And what the chances, the risk that you're taking here is that these calls could be executed if these stocks go back up, shoot back up exponentially like this. They could be called away. So if they're called away, play the game somewhere else. But maybe you want to play it in more defensive stocks that pay dividends. That's what Warren Buffett is doing. Maybe you should take his advice and get into defensive stocks. There's no free lunch. You're dealing with highly speculative stocks in the technology sector. And once the bubble bursts, their price-earning ratios on these stocks is through the roof. The same thing with Tesla. It's in Google. They're through the roof. They will plummet in value. When the bubble bursts, they will go down. This is a way of protecting yourself. That's all I'm trying to do is give you an ideas on how you can protect yourself in a market decline, especially when the bubble bursts. Anyways, I've been speaking long enough. Just try this if you think it's suitable for you. And maybe just try it on 100, 200 shares. That's all. Not on your whole portfolio. Just see how it works. If you don't like it, you can always unwind the positions and play the game like you've always been playing. Anyways, until we meet again, I appreciate it if you could subscribe to my YouTube channel and pass this video on to other people. Again, remember, as I say in all my videos, well, at least what I remember, liquidity is king, not Elvis. Take care, folks. Hope to see you again. Bye now.